Welcome to This Explainer, where we're breaking down whether cost segregation actually makes financial sense for your Kansas City rental property. If you're an investor looking to maximize your returns, you've probably heard the pitch, right? Run a study, unlock a massive first-year deduction, and pay way less in taxes. But today, we're going right past the glossy sales brochures to look at the real, hard math. Let's dive in.
Just a quick heads up before we begin. This explainer is strictly educational, so it's not legal or tax advice. And remember, as an investor in the specific metro, you always have to account for those tricky regulatory differences between Missouri and Kansas. So definitely consult your own CPA before making any big tax moves.
To navigate all of this, we're leaning on the authoritative data and local experience of Alpine Property Management Kansas City. They've been serving investors in the metro area since 2013. Founded by Marcus and Cara Painter, Alpine currently manages over 250 properties. They're literally at ground zero of this strategy. They see exactly which deals actually pencil out for buyers and which ones quietly end up costing the owner more in fees than they ever save.
Okay, here's our roadmap for today. First, we'll hit the cost segregation basics. Second, the 2025 tax law changes. Third, doing the Kansas City math. Fourth, passive income and recapture traps. And finally, number 5, planning your next steps. All right, let's jump right into Section 1, the cost segregation basics. What exactly is it?
Normally, a standard residential property depreciates equally over 27.5 years. You essentially take the value of the building and spread that deduction out in equal slices for almost 3 decades. It's slow and steady. But an engineering-based cost segregation study takes a totally different approach. It breaks the building down into its individual pieces. It reassigns components like your appliances, the carpet, flooring, cabinetry, and even site work like driveways and fencing into accelerated buckets. We're talking 5-year, 7-year, and 15-year property. Suddenly, everyday items like your kitchen cabinets or the driveway outside are moved right up to the front of the line for tax deductions. It's a massive shift in timing.
Moving on to Section 2, the 2025 tax law changes. Let's talk about bonus depreciation.
Now, bonus depreciation had actually been phasing down over recent years. It dropped to 80% in 2023 and then 60% in 2024. But then came the One Big Beautiful Bill Act. It was enacted as Public Law 1119-21 and signed in July 2025, and it reversed all those previous phase-downs. It permanently restored 100% bonus depreciation.
So here's the absolutely crucial point for you as an investor. Items in those shorter buckets, anything 20 years or less, can now be fully written off in year 1 provided the qualifying property was acquired and placed in service after January 19, 2025. Instead of taking 60 or 80 cents on the dollar, you get the entire deduction immediately. This single change restores cost segregation to its absolute strongest form.
Section 3, doing the Kansas City math. Let's see what this actually looks like in practice. Before we can even calculate your potential savings, we absolutely must define depreciable basis. This is a vital concept for you simply because land itself never depreciates. The IRS only lets you depreciate the building and the improvements. This perfectly explains why a lot-heavy property in a pricey submarket like Leawood or Overland Park might return far less tax benefit than you'd expect. A huge chunk of your purchase price went straight to the dirt, which severely shrinks your reclassifiable basis. And this brilliantly illustrates the local math. It shows exactly how Class B properties in Raytown easily clear the threshold, while cheaper Independence homes sit right on the fence. Just look at that Raytown example. You buy it for $225,000. Strip out the land value, and you have about $185,000 in building basis. By reclassifying roughly 25% of that into faster buckets, you accelerate $46,000 right into year 1. For an investor in a 32% bracket, that defers nearly $14,700 in taxes against a $2,500 study fee. That's a clear, undeniable win. But look at the $150,000 Class C home in Independence. It only nets a marginal win because the study fee eats up a much larger share of the overall tax benefit. To keep things incredibly simple, Alpine advises buyers that the first-year tax savings should clear the study fee by a comfortable multiple. They usually recommend looking for at least 5 times the cost. You see, the study fee scales a lot more slowly than the tax benefit. This means larger deals with more building basis will easily clear this threshold, while the cheapest properties require very, very careful consideration before you pull the trigger.
All right, Section 4, passive income and recapture. Let's uncover the hidden traps.
The absolute biggest trap that sinks cost segregation deductions is the passive activity loss rule.
If you have a regular W-2 job, your massive new tax deduction might just sit there idle. Rental real estate is considered passive by default, meaning it generally can only offset other passive income. If you don't have other passive income, that huge deduction parks itself as what we call a suspended loss. There are exceptions, of course. A special allowance lets some folks deduct up to $25,000 against ordinary income, but that phases out completely if your modified adjusted gross income hits $150,000. Now, the ultimate workaround here is real estate professional status, but that demands over 750 hours and more than half your working time dedicated to real property trades. So if you're an out-of-state investor with a full-time job, you likely won't qualify for that.
Let's say you clear that income hurdle and you can actually use the deduction. Awesome. But you still must ask yourself this critical question about your exit strategy. What exactly happens when you decide to sell this property?
You have to realize that accelerated depreciation is essentially a loan against your future self. A short hold can trigger a recapture that completely converts your gain into a higher tax category. Well, unless you utilize a 1031 exchange. All that personal property you moved into the 5- and 7-year buckets comes back to haunt you at ordinary income rates under Section 1245. If you plan to sell the property outright within a few years, you might just be turning a helpful tax deferral into a total wash. Honestly, pairing your cost segregation study with a long hold period or a 1031 exchange plan is really the only way to ensure your front-loaded deduction turns into a lasting financial benefit. Which brings us to our final part, Section 5, planning your next move. Let's talk about executing this correctly.
Any serious investor needs to follow these 3 practical steps before they buy. You need to ensure your basis, your income, and your hold horizon all point in the exact same direction. First, talk to your CPA to confirm you can actually use passive losses against your current income this year. Second, don't settle for a generic estimate. You need to get a concrete fee quote tied directly to the specific property you're evaluating. And third, lock in that long-term hold or exchange plan so recapture doesn't ambush you at the closing table down the road. You absolutely need to make these decisions before you close on the property, not scrambling in April of the following year.
I want to leave you with a provocative truth from the team at Alpine. Cost segregation is a timing tool, not a discount. You're not getting free money here. You're paying a fee to strategically rearrange your deductions, basically moving them forward in time. If you can't use those deductions right now, or if you plan to sell before the benefit actually compounds, you're just paying a premium fee for a tax schedule you can't even exploit. Cost segregation is an incredibly strong tool in the right hands, but for sure it requires precision and a lot of planning.
For help managing your Kansas City rental property, call Alpine at 816-343-4520 or visit alpinekansascity.com. So before you sign those closing papers on your next property, ask yourself a hard question. Are you actually buying a long-term investment, or are you just buying a tax deduction you can't afford to keep?